I'm actually surprised I don't see more tax accountants and tax advisors talking about this on YouTube or through other social media platforms. But now that we can use AI to create things like books or courses or architectural plans, it's now been easier than ever to create value inside of a product or service and turn that into a business. And I want to teach you a tax strategy that will save you tens of millions of dollars from being taxed. Where other tax accountants might give you strategies to save you $1,000 or $2,000 or $10,000 in taxes, this is millions of dollars. So pay attention as I walk you through everything. I'm a tax advisor with Square Accounting based in Orlando. And for the last 15 plus years, I've been helping companies in the $5 million to $100 million range with growth, profitability, risk, and most importantly, saving on their tax liabilities. The tax strategy that I'll be discussing is the QSBS, which stands for Qualified Small Business Stock. And this is buried in the IRS tax code, section 1202. And there's a catch. With the QSBS, you don't set this up at the time you sell your company. You set this up practically in the beginning, or you miss out on all the tax advantages forever. Today, I'll be breaking down what the QSBS is, how the $10 million exclusion actually works, the requirements you have to meet, pitfalls to avoid, how this applies if you're specifically starting an AI company, and a real-life example of how you can exclude up to $10 million worth of income from being taxed. The QSBS states that if you own qualifying stock in a qualifying small business and you hold it long enough, then when you sell, you may be able to exclude a big chunk of your capital gains tax from federal taxes. At a high level, the QSBS is designed to reward founders for putting in cash and operating a real company, not just a passive investment vehicle. And here's a juicier detail about this strategy. It's not only $10 million, but it's $10 million or the greater of 10 times your cost basis. So the exclusion can potentially go up based on how much money you've actually invested into your own company. So if you've invested more than $1 million into your business, and assuming you didn't take any non-dividend distributions, you could have a greater than $10 million exclusion when it comes time to sell your business. Now we'll talk specific rules about this QSBS strategy. And if you miss on any one of these requirements, it will mean a total loss on all the benefits. So that's why I'm emphasizing you have to be very intentional when it comes to this tax strategy. Here are the 5 core requirements. Number 1, you must set up a C corporation, whether from the beginning or an LLC taxed as a C corporation. You should set this up very early in the company's existence. Number 2, you must acquire the stock in the beginning of the corporation's existence. So although founders, this is typically an easier requirement to hit because as soon as you set up the C corporation, you're issued shares at that point. You can also acquire this stock from an earlier financing round for the company. But if you're buying shares from another founder, then these typically do not qualify. Number 3, to qualify for the small business, the assets must be less than $50 million. So I would definitely emphasize on doing this conversion or formation before you accept any seed rounds or investments. Requirement number 4, the company must be a qualified trade or business. Here's a short list of excluded industries and most service businesses where the primary value is in the reputation and skill of its members. Those are typically excluded. However, software and AI companies are commonly eligible if structured as an operating business. And the 5th requirement is that this is an active business, meaning that at least 80% of its assets are used on the operations of the day-to-day. This is to avoid companies that are simply investment vehicles. Outside of the 5 core requirements, there is also a rule that you must hold this stock for at least 5 years. So if your plan is to build and sell within 2 to 3 years, the QSBS exclusion may not help unless you're doing advanced tax planning. If you're thinking of building something that may last 5 to 10 years, then the QSBS becomes a serious option for it. So let's review how this $10 million exclusion actually works. Let's say you start a C Corp and you're developing a software with the use of AI. In general, you're probably not going to invest a lot of money unless you're investing with purpose. Then assume 5 to 7 years later, through growing sales, the company sells for $10 million. If you followed all the rules from the QSBS, you may exclude up to $10 million from when you sell from federal taxes. And assuming that you also strategized your residency and chose a state like Florida to live in with 0% state tax, you're paying zero taxes on all those $10 million of capital gains. Like the residency, there's some other nuances with the tax planning, like bringing in your wife, who may exclude an additional $10 million or more, gifting QSBS stock before big appreciation, or through the use of trusts. But I don't want that to distract you from the overall picture of how much it actually excludes just doing the bare minimum. And why have I chosen the AI software company example? First of all, they often scale very fast. Exits can be very equity heavy, and founders already incorporate as a C corporation, as a Delaware C corporation, just to be investor friendly. Now, here's a checklist that you should be thinking about early on if you think the QSBS strategy is right for you. First, as mentioned, you have to form a C Corp, again, often in Delaware, just for investor compatibility. Number 2, issue founder stock early at a very low valuation. Consider an 83B election if you have stock options or vesting options for your employees or investors. Number 4, track the $50 million gross assets threshold. Number 5, maintain documentation that you're an operating software business and not just an investment firm. And number 6, with redemptions, purchases, and cap table moves, these can create QSBS issues, but this mainly applies if you're transferring stock, but that's more of a complicated process, and you should definitely seek an advisor's assistance if you're at that step already. Because this is an advanced tax strategy, don't think of the QSBS as simply a tax deduction, but this is more of an architectural design in your tax formation and long-term planning. So now that we talked about requirements, let's talk about common pitfalls that founders usually get trapped with and completely disqualify their exclusion. If you operated for years as an LLC and wait too long to convert to a C Corp, you get hit with a few issues. Number 1 being that you have to now extend the holding period from that point of conversion. So you have to wait 5 years from when you converted your LLC to a C Corp. And second, it might be harder to qualify because you might be over the asset threshold or one of the other requirements needed. Number 2 pitfall is the 83B election. Now, this is a bit complicated, so you definitely want to consult with somebody if it's needed, especially if you have stock options or vesting options. Number 3, if you're using your assets as investments rather than for the operations of the business. So don't just plan a QSBS in a vacuum. Plan it with your residency and exit timeline in mind. It might be worth planning your residency change before your exit, especially into a state with little to no state income tax, like Florida, where we're based out of. So now let's take a deep dive on how to get a company or how to build a company that's worth $10 million. And we'll use 2 examples of an 8x multiplier and a 10x multiplier, which is very common for AI software companies. In software, people often talk about multiples as it relates to the annual recurring revenue, or sometimes multiples on EBITDA, which is like net operating income. The multiples are also affected by the type of business and also the margins you have. Let's assume you have $1 million worth of revenue or annual recurring revenue. And other 2 assumptions are that you have extreme growth, meaning last year you made $500K and now this year you're at $1 million. On top of that, if you are an AI software company, it's assumed that you have very, very high margins, meaning in the 80s or 90% margins. This type of situation would put you in a very extreme high multiple, and let's assume 10x multiple. So this would get you with a $10 million valuation with only $1 million worth of sales. And if you had a slightly lower growth rate, meaning you went from 600K last year in sales, and now you're at $1 million in sales, maybe they might discount your multiple down to 8. So if you had $1,250,000 of revenue and you had a growth rate slightly less than our last example, they may offer you an 8x multiplier, meaning on your $1,250,000 of annual sales, your company's worth $10 million. If your software is more services heavy or less reoccurring sales, buyers may calculate your value based on EBITDA. And that phrase commonly is attached to net operating income. But for a clean SaaS-based AI business, annual reoccurring revenue typically applies. So let's play this scenario out where one person used the QSBS strategy and one person didn't. At the end of when each person sells this company, one will get hit with a massive tax bill, practically over 50% in some places, and the other one will be walking away without any tax being assessed on his $10 million. And that's including if he followed the residency strategies as well. So now you have to ask yourself, is $5 million worth it for me to assess this strategy and implement it, or is it not worth it and I like giving $5 million to the government? You got to ask yourself that question. So if you're thinking about starting an AI company or are in the process of developing an AI solution or a software solution, you should really assess if the QSBS strategy is right for you. This is one of those areas where even a 30-minute conversation can have a massive impact on your tax liabilities. And we're talking about in the 7-figure range. The QSBS tax strategy, section 1202, is one of the most powerful tools for founders and investors to take advantage of early on. And if you're able to conform to all the requirements and the rules, an exit strategy within 5 to 10 years could be massive for you. This type of strategy should be a part of your conversation, and you should take it to your tax advisor or tax accountant to discuss it further, because you don't want to regret not having looked into it when you receive any offer to sell your company. So if you found value from this video, please like, comment, and subscribe. And also, if you need more clarification, feel free to visit our website, sqaccounting.com. I appreciate it. Thanks.